first, we have Andrew Morse. He is the Senior Vice President at Global Atlantic, a leading annuity and life insurance company. In his current role, Andrew leads a team of 14 and also collaborates frequently with various functions and customers inside and outside of the company. Great to have you here, Andrew.
Thank you.
Yes, of course. Next, we have Oren Shani. Oren is a credit advisor and certified business coach with AOF. And Oren has over 10 years of experience managing businesses and advising other business owners. He started, managed, and expanded his own business, providing disability accommodations for live events across the country, and he now helps entrepreneurs launch and grow their own businesses. Hey, Oren.
Hello, thanks for having me.
Oren, I wanted to see if you could just kick us off with an overview, or what are these key documents that business owners should have in mind?
When we're talking about financial statements, there's really three primary types of financial statements that all businesses of all shapes and sizes should be mindful of and should be tracking on a regular basis. That's going to be your profit and loss, your balance sheet, and your cash flow. And I'm going to briefly talk about the differences. A balance sheet is a little bit different. A balance sheet is really more of a snapshot of the valuation of your company at any given point. So all businesses have value, right? There's a monetary value associated with your business. Your balance sheet is going to reflect what that value and net value is.
Balance sheet is compared to a photograph, a picture. It's really a point in time, right? So what we're trying to get, as Oren mentioned a few minutes ago, is the value of your business at a point in time. People also describe it as what you own and what you owe. There's basically three components of a balance sheet which are important. Assets are what you own at any point in time. And again, you could choose a date. Usually December 31st, 2023 would be like a typical date. End of a year, end of a month, end of a quarter. Assets are what you own. Liabilities are what you owe. Bills for services, long-term debt, and equity is the value that you've created over time. There's basically a couple subcomponents of each of these. You have current and long-term assets. So current assets are things which will convert to cash generally within a year. So that would include cash. That might include a receivable from a customer. It could include inventory if you're an inventory holding business. I did see in the chat there's a lot of service companies and a lot of companies that have inventory. I think we have both represented very well on this call. Everybody's going to have a different looking balance sheet, right? The types of assets that you have are going to be very different based upon your business. Long-term assets are things that are not going to convert into cash within a year. So that could be an IT system that you pay for, right? And maybe it's helping you for 10 years. It could be a building, it could be furniture, things which will last for more than a year are considered to be long-term assets. Liability is very similar. Anything which you need to pay within a year, typically considered a current liability, and then things which are a year or farther out are long-term liabilities. That could be maybe long-term debt. So again, like rent payments would be current liabilities. Long-term debt, if you borrowed money for 5 years, that would be long-term liability. And then equity is the difference between assets minus liabilities. So if you take all of your assets, you subtract all of your liabilities, you have your leftover value, your equity. That's also parsed into 2 points. Paid-in capital is the amount that you started with and you invested into the business, right? So you start with an amount, and on day one, that's what the business is worth. And then over time, you generate earnings or you generate losses. It can go both ways in any phase of the business. All of that is normal. But over the course of time, you would expect to generate earnings. And, the other component of equity is the retained earnings, which represents all of the wealth which you've generated, the surplus you've generated over the history of the business. Assets equals liabilities plus equity, which is another way of saying assets minus liabilities equals equity. The next 3 slides say very much the same as what I went through in the top slide. Current assets, again, convert into cash within 1 year. Inventory, accounts receivable, security deposits, cash. Long-term assets, not easily converted to cash, but instead they are used to produce sales. So I think the part I didn't mention in the top is that those assets do have value, but their value is a little bit more abstract, right? So you have an asset which is going to help you do business for a number of years, and so that gets assigned a value, and that could include things like equipment, furniture and fixtures, leasehold improvements, real estate, land, and intangibles. I don't know if anybody here has intangibles, but intangibles might be something like intellectual property. Like if you have something which is a value to your business, which you've assigned a value to, but it's not something you can touch. That's called an intangible asset. Liabilities. Again, current liabilities expected to be paid within a year. Accounts payable, credit cards, lines of credit, income taxes payable, all of your current bills. Long-term liabilities have a repayment period of more than 1 year. Mortgages, equipment loans, long-term debt. It is what you as the entrepreneur have added as value. So really you have the stock, which is the value to your ownership, the initial investment. And then you have, stock and paid-in capital. So stock and paid-in capital can both be considered investments that somebody made into the business. And then retained earnings is the value that the business builds up over time. And there's an important note to that for entrepreneurs and business owners too, right? That amount builds up over time, but then you can also take it down by distributing money to investors, right? So it does accumulate, but then as you distribute dividends, then the retained earnings comes down. You can consider that to be like a bank, right? So you might build up $100 of retained earnings, then you pay out $20 in dividends. The $20 in cash goes out of your bank account, and then your retained earnings amount goes down by $20 as well. So again, this is repeating the same concepts in a visual format. Here you've got your current assets, which for Paul include cash, accounts receivables, prepaid rent, and inventory. Paul presumably has a lot of guitars and strings and other things in his inventory, which is worth $39,000. All of that equals his total assets of total current assets of $73,000. The long-term assets include the $100,000 which Paul spent to build out his shop. He spent $100,000 fitting the shop, which are called leasehold improvements, and that has value for him to sell guitars for the next 10 years, maybe longer. And so there's a value to that, which is assigned as $98,000 in his financial statement. So his total assets are $171,000, comprised of the current plus the long-term assets. And liabilities, very similar. He has bills that he has to pay of $49,000, accounts payable. He has accrued expenses, $450,000. Again, there might be something which has been accrued through the end of this month, but it hasn't been billed yet. But he's captured that as being an expense that he incurred. And then unearned revenue is it's sort of a complex topic, but that's another accrual topic where he may have received money, but he hasn't earned it yet, so he sets up a liability for that. But really, accounts payable is the driver of the current liabilities, 49 out of 50,000. And then he has long-term liabilities, which I'm going to infer is maybe like a long-term debt that he borrowed money from a bank or a mortgage, maybe to make those $100,000 of leasehold improvements. And so he owes that over the long term. So his total liabilities are $149,000. Total assets of $171 minus total liabilities of $149 equals total owner's equity of $21,950. That's how much the business is worth as a book value. And that is made up of $10,000, which was put in as common stock as an investment, and then $11,950, which represents his retained earnings, the accumulated earnings less anything that he's distributed to investors over the life of the business. So there are ratios. When Oren was going through the ratios, I wondered whether out of the 120 people who are on here, some people probably love to go through the math on these ratios, and other people might be harder to follow. So we're going to go through a couple here. I would say not every single ratio is equally important to every business, right? So the concept of ratios is very important. And I would say that every single business person has a ratio or two or three, which is probably super important to you. So I think the key is figure out what it is that it's important for you in the business to tell you whether you're healthy or not, you're growing or not, and then focus in on that. I do find that reporting ratios month over month, quarter over quarter tends to align people around action, right? If you measure the thing which is important to you, you tend to get better at it, improve it, and sort of focus towards that thing. So I'd say ratios are very important, but it's really tailored to the business. So I'll also, similar to Oren, explain a couple representative ones to you on the balance sheet. The first one is the cash ratio. The cash ratio is total cash divided by total current liabilities. So that basically, in this example, you have $32,000 of cash, but you have $50,000 of payables. So you have a 65% or a 0.65 cash ratio. That means to me that this is a lean business. Paul's making money just in time to pay his bills, right? Some people might have a cash ratio of more than one. If you have $60,000 in cash for $50,000 of payables, that means you have enough cash to pay your bills and have a little bit of extra. Both any cash ratio can be fine for that company, right? Somebody might think 0.65 is the best way to manage the business. Other people might want more cash, but if that's an important ratio to you, that would be one that you could report on. it does give you a sense for whether you are cash constrained or not. So this is one that could be helpful if you have concerns about having enough cash. Like, this is a good ratio to have. And then the net worth, right? So this is where we talked about already the sort of value of the business, total assets minus total liabilities equals the net worth. We've covered that concept in a couple places already. I would just say, as we apply this to your businesses, I think that the net worth of a balance sheet heavy business, which has inventory and that type of thing, might be a little different than a services business. The services business is going to be not very heavy on the balance sheet. You're basically just going to generate earnings based upon your people and your services every quarter. A balance sheet heavy business where you have inventory or you have products, you're going to have a lot more sort of baked into your assets and liabilities going into this. But regardless, every one of us as business people has a bottom line net worth, which is important.
Awesome. Thank you so much, Andrew. That was really helpful. I think especially when you said different ratios are important for different businesses. So find what you want to pay attention to.
Thank you to Oren and to Andrew for taking us through this conversation today and answering all those wonderful questions. We will see you in the next one. Bye.